Welcome back to the Reimagine Ownership Podcast. I'm thrilled to be joined by my friend and a metaversal advisor, Itay Tuchman, today from London. He is super jazzed because there is a major soccer tournament taking place this evening. Who's on the field? Who's on the
Arsenal PSG Champions League semifinal. So come on, you Gunners. It'll be a big night.
Why
for
is
us.
this such a big deal? Big night.
Big night. Well, first time in almost 20 years for Arsenal in the Champions League semifinal. I have more than one religion. I am Jewish, but my football religion. I'm a North London Gooner through and through. So me and 60,000 of my closest friends and my family, pray for us, Dan. Pray for us. Anyway, we'll kick off.
Yes, we will pray. And so you haven't eaten.
Haven't eaten.
You haven't been sleeping, and you bring that enthusiasm right here to our pod today.
Of course.
So we were talking about rolling back the clock to the young Itay and your storied career in traditional finance. Fill us in a little bit, because that storyline is going to help get us to the term TomNext.
Great. I mean, so Dan, I don't know about you. I think we're in the same age bracket, but I very much feel I have some grays here. You're here. I got plenty of hair, but I got grays here. I was very fortunate to come of age, and I mean this even before my professional career. So my parents, who are not finance people, let me keep $1,000 of my bar mitzvah money in the early 90s. And I took that $1,000 and opened an account with, I think at the time it was like Ameritrade or something predating Ameritrade, when the internet was like super nascent. And I don't know why, as a 13-year-old, I was obsessed with the idea of trading equities, writing options against high-flying internet stocks in the early and mid-90s. But I was doing all of that. And the start of my journey really focused on digitization. Like, without digital, there is no me, there is no Wall Street career for me. I wouldn't have met my wife, probably wouldn't have had my kids. And so I was very fortunate to come of age professionally and personally in the age of digitization, right? So it was the internet that really led that. So I didn't have to necessarily go to the Wall Street Journal and call a stockbroker. So post-uni, I started at Citibank in New York. I was lucky enough to move in the foreign exchange business, actually in what was then a kind of small part or backwater of the financial services or trading business, something called short-term interest rate trading, which is really things like foreign exchange swaps, things that if you read about the Mar-a-Lago Accord, you'll read about foreign exchange swaps. But these things were very, very unknown. It was everybody knew about stocks and maybe a few people knew about bonds, but the idea of being a short-term interest rate trader may have been one of the boring areas of trading. Fast forward into the crisis.
You mean that's straight jargon?
I'll be honest. I was dorky kid from Minneapolis. So, any ladies would have picked me up rather than the other way around, because I didn't have the self-confidence back then to do much of that. But I was always into the quantitative side of financial services. We did some cool things. And then fast forward to the financial crisis, from being this kind of fringe, almost operational trading business related to foreign exchange and interest rates, we became the epicenter of the world of financial services. And I really mean that. What we did, the business that I ran for Citi at the time, short-term interest rate trading, was the only kind of liquid business that allowed banks and customers to fund themselves across borders. The CP market shut and was closed. So European banks couldn't issue commercial paper in the US and US dollars anymore. They had plenty of EU deposits. They had dollar assets. You need to do FX swaps. FX swaps is kind of like the last pipe that remains open when all the other pipes between banks and financial services companies are shut. And that was the story of the financial crisis. So that business went from a small esoteric business to sort of an epicenter business on Wall Street. Since then, it's been an enormous business. I've been involved in that, was involved with that for a good part of my career. It's a really macro business. It's a business that really has to understand both liquidity, what central banks are doing, the demand for hedges. It's related to where interest rates are going. It's related to where FX is going. It's related to where the universe of the plumbing of financial services is going, how payments work, how all these things work, right? And the biggest transaction in that business, a transaction which is probably the biggest and most important in my opinion, financial transaction still of the world today is what's known as a TomNext swap, which is where the name for my company came from. And a TomNext swap seems like a very simple transaction. I'll try to describe it to you in 5 seconds. Feel free to Wikipedia, Googlepedia, or ChatGPTpedia this if you're a listener. But because the foreign exchange market, for historical reasons, trades with a settlement timing of T+2 days. So Dan, if you and I do a trade today for €1,000,000 against what's probably now $1.15 million, we settle that trade 2 days from now. Okay, T+2. And the reason that exists is because we needed to allow enough time, like financial services, banks, participants, to reconcile the trades, to deal with errors, etc., and then to like prepare for settling the trade. So the convention became T+2 days because you're doing all this reconciling. Tomorrow I'm funding the trade. So every day that I have these balances, they're moving closer to T0. They're moving closer to the day today that I actually have to pay you the money. And in the FX industry, nobody actually wants to settle anything. What we want to do is to keep pushing that date into the future to, again, match our books. So the biggest liquidity trade between banks and also major financial services players, I'm talking about trillions a day, happens in a swap where we move foreign exchange balances from T+1 back to T+2. So that's a TomNext swap. Every day I'm taking my book to avoid it going to T0 to tomorrow, where I'm going to owe hundreds of billions of dollars to other counterparties that, frankly, I don't have. I have to fund. I'm rolling it back to T+2. That's known as a TomNext swap. It's one of the biggest financial transactions in the world. It is one of the transactions that is absolutely critical. If this market shut for whatever reason, we would all be eating worms and grubs. So this thing
is the plumbing. It's the essential plumbing.
It's like the plumbing of the plumbing, right? It is like, okay, most people see the plumbing.
And yet I can't help but think of Popeye and that character Wimpy, who always says, "I'll gladly pay you Tuesday for a hamburger today."
I'll gladly pay you Tuesday for a hamburger today.
That is how it works. Banks want to avoid, and this is where we dovetail into the crypto or blockchain conversation, atomic settlement conversation for you blockchain nerds, which is part of the issue with with money overall, but also with securities overall, is the issue of settlement. Right. The reason this exists is because specifically we don't ever want to settle these balances. We want to avoid settling. We want to roll our positions so we minimize the amount of settling that we have to do. We're always rolling our balances forward. Right. So that's a great analogy from Popeye. And it dovetails with what happens in the blockchain industry and what the point of all this is, which is ultimately the reason it's T+2, the reason there's all these inefficiencies, the reason that actually this is like super cumbersome and is expensive, because it's actually very difficult to settle safely. I'll give you an example, Dan. So let's say we did that transaction where I bought €1,000,000 off of you, or let's make it even better. I bought $1,000,000 off of you, which is even better because of the time zones, right? And I owe you for that $1,000,000, whatever the FX rate is now, let's call it $650K US. Okay? And we don't roll that transaction. So come T+2. So come, I guess today's a Tuesday. Come Thursday, I have to settle. But how do I settle? Right? I have to give you the Australian dollars, or again, you give me the Australian dollars in Sydney time, which is whatever it is, midnight New York. You're giving me $1,000,000 Australian dollars from your Australian bank to my Australian bank before I gave you anything. Right? And then you're waiting around 12 hours for New York to open for me to give you the $650K US. Now, multiply these numbers by many, many zeros, which is what banks are doing. Okay, that's called settlement risk or Herstat risk. Now, there are problems with that. What happens if, as an institution, I fail in between those two moments? You are out a ton of money. So there are many things that banks and financial services companies do to mitigate that risk. We set up a big global bank called CLS that all the major banks contribute to and pay for, to try to create almost a clearinghouse for these settlement risks. We build these systems upon systems to deal with these settlement risks. But the reason we have them is because I can't pay. One payment system is open at one time, another payment system is open at another time. They don't talk to each other. They don't interoperate. Now imagine the world of atomic settlement, where it was open 24 hours a day. We didn't need a bank in the middle. And the minute that I sent you the $1,000,000 Australian dollars, 24 hours a day, we didn't need a bank in the middle. And the minute that I sent you the $1,000,000 Australian dollars, 24 hours a day, we didn't need a bank in the middle. And the minute that I your settlement would come on the other side of mine. Otherwise, the transaction would fail, right? Like I would never have risk to you for settling that transaction. Savings, first of all, savings, capital, liquidity savings, right? I've got to fund that $1 million before somebody gives it to me. There's so much cost associated with our legacy financial services architecture that this is just like one microcosm of that we spend time, energy, money, capital, regulation to deal with. That again is really just about technology. Like, of course, we need Fedwire to open 24 hours a day. We need the Australian, central bank system, all these things to like, but this is where technology revolutions, which are they're not continuous. New technology is kind of discrete. Something gets invented. And now we say, okay, can't we use this to imagine now we can use stable coins rather than these bank money systems. So this is all related to all the innovation that's happening on chain. And my personal view, there's tons of like aperture. The design space for blockchain is so large, but I always start with settlement or payments because it's so obvious to me. I think it was obvious to Satoshi. The first line of the white paper is about payments. So it's obvious to Satoshi. I'm not Satoshi, obviously. But it's very obvious to me that the payments use case, the settlement use case, the ability for us to exchange value algorithmically, formulaically, and at the same moment in time is a huge part of this evolution. Sure. And of course, in my professional life, I ran big market making businesses. Speculation is part of the liquidity, of the universe, right? So, I mean, it's not that speculation isn't an important part of this ecosystem, but the reason I don't focus on it is because ultimately we're speculating on a future state that really hasn't been fully delivered yet. So it's easy to say, well, what are these tokens worth, and et cetera. It's interesting. But I'm really focused on like driving the use cases. And for me, let's start with like settlement or the idea that it's just easier to transact, right? Like it's easier for me and you to exchange things of value. So I like to say, okay, what's difficult? Like, let's start with what's very difficult to exchange. There's two ways to think of it. We can take what's already pretty good and make it a little better. That's things like this FX settlements I was talking about, or bank rails, or payments. I think, I live in London, right? So a lot of Americans, blockchain Americans tell me, oh, it would be amazing if I could just pay you instantly, right? Like, bro, just come to the rest of the world. We just use bank accounts. We pay you instantly. Like, so if I just have your sort code and account number and name, Dan, I can send you pounds in less than a second, right? So let's just think bigger than that. Right? I really look at the things that have high friction. And what we focus on at TomNext is alternative assets. These things have super high friction, right? So I want to be, many of you should want to be an LP in Metaversal, if Dan would ever let you be an LP, but to execute that, to say, okay, Dan's going to take my investment, return to me, like whatever it happens to be. In the traditional case, it's documentation. You've got to get KYC docs. This is done very, very analog. And then somehow I'm like instructing a wire transfer to some escrow account. And then Dan has to gather a whole bunch of papers. Dan, and then once the papers are all gathered and your lawyers are all happy, and this takes weeks and weeks and weeks, that money gets released to you, and I get back some kind of like subscription document that's fully executed, et cetera. Like, so cumbersome, right? When what we're really trying to do is to make that modern from a technology perspective. And that's just like one example of things that have very, very high friction. I mean, you can go through tons of them. You can go through buying a house. The real estate game is super frictional. I mean, anybody who's, whether it's in the UK or the US or anywhere in the world, I've been fortunate and unfortunate enough to own property in different places in the world. Like, surely we should be able to move that onto digital rails to reduce the friction for the willing buyer and the willing seller to meet, negotiate, and complete. Right? And so part of like the vision, and I think it started with Bitcoin, and obviously like I have to admit, I was reasonably early to Bitcoin and very late to smart contract blockchains. So 1 for 2, maybe one for 100, or maybe that's the answer, is the ability to orchestrate those kinds of things. But the speculative use case is really not part of like establishing that architecture. I mean, that's nuts and bolts technology work, user interface, user experience, right? Like, so for me to want to buy a house and to complete on chain, like, let's just think about that. Boy, there is a lot of work that needs to happen in this ecosystem for me to feel comfortable to negotiate for an apartment and then to like complete on chain, right? There are things like the legal certainty, like who's actually providing what service. Of course, though, like house how safe and stable are the monetary rails of the stable coins that we're using, making sure that that's all like, okay, I'm sending you the $1 million for the house. Okay, houses are super expensive now. Maybe I should say 100 grand, but $1 million for the house. Like, to know that at the moment that money leaves my hands, it's executed against ownership of the house. I don't need an escrow agent because it's like certain. There are so many architectural things that need to happen under the hood. We work on some of those. Other people work on some of this. And I think we have to admit these things take a long, long time to engineer.
Your latest venture.
Sure. Okay. So,
because you came inside and out.
So, okay. So I will, I always like to tell a story, Dan, you know me. So start with a story. So I remember I was like at a crypto conference a couple years back. Again, could have been Token 2049, one of these big major conferences. And I was on stage as the like finance guy, right? And it was being hosted by a really nice chap, DeFi oriented guy. And he said something like, you know, blah, blah, blah. There's this conspiracy that banks don't want blockchain. So there's like a regulatory conspiracy between regulators, major financial services companies, never to allow crypto to be anything, et cetera, et cetera, et cetera. That's why nothing happens, this giant conspiracy. And so like, I don't know. I'm Israeli, Dan, as you know, so I have a hard time not speaking up. So I kind of said, okay, let me just tell you, there's like 500 people in the room. And I was running global foreign exchange at Citi at the time. And I said, I am certain that in this room, I am the most regulated person. Like, Google me, right? So I spoke to the OCC, the Fed, the Bank of England, MAS in Singapore, Bank of Japan, and any number, ECB, any number of central banks and regulators on a very, very regular basis. Sometimes they were like, you know, inspecting us. Sometimes it was a regular catch up. Sometimes it was ad hoc. Like, I spent a lot of my career with global regulators, right? First of all, there's no conspiracy. Sorry. That's what I said. I said, there's no conspiracy, guys. Sorry. This technology is very disruptive, right? If you think of the incentive of the regulators, and we'll talk about the political change in the US in a second. If you think about the incentive of a regulator, it's move very slow and don't break things. Right? If you think of the incentive of a VC or a startup founder or whatever, it's move fast and break things. These things are naturally in conflict because the cultural incentives are different. It's not that the regulators want to stifle innovation, but they don't want to deploy it until it is fully safe and sound and controllable. Because if something goes wrong, the taxpayer has their heads on a stake. Okay, so there's an incentive mismatch. These are smart people, by the way. There's also this like view that regulators, there's tons of regulators and they're not smart, and the crypto people and all these technology innovators are super smart. That's also like completely wrong. A lot of these people are super well educated. They read a lot. Some of them like played around with crypto in their spare time, etc. But that's the first thing, which is like these things are naturally in conflict, right? Now, the second thing I will say is that you have global technology but local regulation. That's a big challenge. Like, to your point, there are places, for example, in the Middle East, I would say Singapore, maybe also an interesting example of like a very more push forward. But remember, like these places don't have the same scale incumbent financial system that the United States does, or that Europe does, or the fragmentation across like 27 member states in Europe. So like these are different places, and they're trying to sort of like be a home for innovation. So the priority of being pro kind of in these two things that are conflicts have different trade-offs for a Dubai than it does for a Dallas or a New York. So like, let's recognize that too, that we don't have a single global regulatory environment for anything, let alone a new technology. So that's also difficult because the technology is by definition borderless. So to answer like this long-winded, that's kind of the third point, which is like, we look at this as like an inevitability. Technology is inevitable. So the idea is that like better financial rails will continue to develop and happen because the technology is there for that to happen, and people will demand it because it's better for them, it's cheaper for them, it can be safe, right? And regulators will kind of like be a little behind the spear point of where the technology is because that's where they're supposed to be. And then you see what's happened in the US. And what's happened in the US, in my opinion, is like simple. It's basically the government saying, we're going to put our anchor in a different part of the trade-off between enabling this kind of like growth and development of something new and making sure that nothing doesn't break in the back end, because there's no such thing as like, if you never want anything to ever break, then you never do anything differently, right? And that prioritization has moved, right? But there's still serious questions in every geography, the EU, US, UK, even in those frontier places about what we do. For example, how do we like manage, I always like to say this in the Bitcoin context, right? So transactions monitoring. So Dan, if I'm like a terrorist or a sanctioned person, I can't send you money. Like the bank that I use will not allow, first of all, I shouldn't have a bank, shouldn't allow me as a customer. You certainly shouldn't be sending me money or whatever. Okay, that's done by gatekeepers in our system. So if we go to a decentralized system that has no gatekeepers or whatever, fine, right? As we all know, the Bitcoin network is censorship resistant, so you can't stop any trade. So you can't stop a terrorist like me sending, quotation marks for those watching, for sending you a few sats. Okay, but what happens, you can say that Dan, if you want to use those sats elsewhere, whoa, they've been sent by a sanctioned wallet, so now Dan has a problem. Simple. How many hops though? Okay, but if I have, Peter, Paul, Mary, Sue, Joe, Mike, and then Dan, how many hops do I have to have before that Bitcoin is considered like fine? Like in the cash system, in the like centralized financial system, if I send money to Mike, right, and Mike is totally no problem, whatever, and he mixes it with his assets, and then a month later he writes Dan a check for $1,000, there's no problem, right? Like that's one hop. In Bitcoin, what are we going to say? One hop, 6 hops, which I think was standard, 20 hops. I mean, these things, nobody knows the answer to these questions. Like we need governments to sort of opine to say, this is the kinds of things you need to do before I'm going to put you on the hook, Dan, or Dan's wallet provider, or Dan's financial services provider, whoever it happens to be is on the hook for these sorts of things. And these are judgments. They take time. It depends on how the universe develops. So I still think there's a lot of movement, but the good thing that's happening in the US, and the thing that I'm like really excited about as I'm American living overseas, is it's also pushing the rest of the world, right? So none of this happens in a vacuum, because ultimately, and I've seen this in my financial services life, the competition for financial services in terms of geographical weight is still ongoing in big scale. Like I remember when I started in my professional career, we used to have trading desks in Frankfurt, Paris, Madrid, Amsterdam, Lisbon. We had one in Greece, like in Athens, and they would all trade, right? Like, and then within a matter of a few years, like everything got centralized to London. Like the whole industry for Europe got central. Is that competition geographically part of what post-Brexit has happened? It's like all these countries trying to pull back financial services, right? So what's happened in the regulatory side with the Trump administration's, let's just say, pro-innovation stance is bigger than pro-crypto. It's kind of like pro-innovation stance. It's going to push the rest of the world to say, wait a second, the last thing we want is New York to eat our lunch. So let's get our house in order.
Or to be seen as anti-innovation.
Look, in the end,
like, you're either for it or you're against it.
I have a startup. We choose to headquarter in the UK. There's certain reasons for that. There were plenty of compelling reasons to go and headquarter in the US or elsewhere. And I'll say this very openly. Who knows, like when we started, if like, I don't know, fast forward a year and the US has like the best regulatory environment, like these things are very competitive. And so I think there's a big story here.
Could come knocking.
I left Minnesota a long time ago, Dan, but that New York and me have had this love and not love affair for my whole life. So who knows? You're in Miami or Northern California. There's a lot of Austin. There's a lot of great places
to serve.
Yeah.
At TomNext.
So Dan,
who should get most excited?
So I will say this, and I really mean this. We're trying to solve one of the hardest problems in, call it, blockchain-based finance, or I don't know, like would use crypto, digital assets, whatever like phrase floats your boat, which is how do we get non-crypto native clients to buy traditional types of financial services products on chain? Right, so we're not trying to solve the how does a crypto treasury get access to yield-bearing stablecoins? Lots of great people solving that problem. Right, that's not easy, but I think it's less difficult than the problem is how do I get a family office in Frankfurt to go, you know what? Yeah, I will invest in private credit in this different new way. Because even though I'm not a crypto OG, right, I'm not a degen in my spare time, right, like I'm not yield farming and airdrop farming, and my kids are not, convincing me every day to do that. I just want a better technology. I don't want to call a human being. I don't want to sign 20 papers, right? I want things in a digital format. And blockchain is the rail that we want to use for that. That's the problem we're trying to solve. So our client base, because we focus on alternatives, it's not because we don't love retail and we don't believe in democratization. It's because the law says alternative assets are the domain of accredited or professional or qualified, whatever words you want to call it in those jurisdictions. So we focus on that kind of segment, high net worth, family offices, multifamily offices, private banks, wealth management firms, right? So the wealthier end of the spectrum. And what we're trying to develop is the idea that you can invest in alternative assets in a digital way, which is much better, more performant than the current horrible analog processes. I mean, I'll unpack that for a bit. So Dan, go back to the 90s, Dan. You were having a ball in the 90s, I'm sure. I mean, I would have loved to have been your wingman in the 90s. Okay. So go back to the 90s. Let's go back to the 90s, right? There were these people. They were called stockbrokers. Okay. And for young people listening to this, if you're like under the age of 30, right, you don't know what the F I'm talking about. Okay. These people.
Wolf of Wall Street.
They've all seen the Wolf. They see, but it wasn't as glamorous as DiCaprio and Jonah Hill. Okay. Like that. These were like people calling dentists, calling, the local car dealership owner or whatever, and flogging stocks, right? Trying to push model on public equities to a universe of investors that didn't have Robinhood or Charles Schwab or Fidelity or any of these kinds of things. They had like an analog brokerage account. And then all of a sudden, like all these technologies, these user interfaces grew up and like nobody pushes stocks. Now you just go on Robinhood, click, I'm on my phone, click, or whatever. Or I get on it. I mean, tons of flavors of this. Public markets are pulled now. People go to a digital platform and they pull the things that they want to invest in and they click and they trade. Right? And then we have this universe of alternatives, which is still push, right? Like you have a placement agent, right? Like, or you have GPs who are like, ringing, who do we know? Who should we focus on? What family? I'm going to go make a trip to like Geneva. Like, let's get a list of family offices. Let's try to push, right? And what I'm trying to say is like the digitization here is going to create a pull model of this universal alternative assets, which is no longer small. I mean, we're talking about an investment universe that's going to reach like $20 trillion worth of investable assets in the next few years. Alternatives, private credit, private equity, venture capital, real estate, debt and equity, commodities funds, hedge funds, all sorts of like what used to be called esoteric investment assets, which are now pretty mainstream. Let's just start investing them in digital ways.
When you talk about that is a cult.
Huge. But by the way,
CryptoPunks.
This is like a moment, right, Dan? Because let me tell you about something you wouldn't have found in the portfolios of 99% of investors in the 90s that today are probably in the portfolios of 99% of investors, which is real estate. I don't mean like your house or like a specific build, whatever you own, like, a commercial, you own a shop front somewhere. I'm talking about like a REIT, a fund that owns a diversified amount of real estate in major cities, and you have some exposure to that asset class in your portfolio. Before the REIT structure was invented and put on public exchanges, like my dad would never have had any real estate exposure. He had his house in Minnesota and the mortgage. So then that is probably his real estate equity. No exposure to like office market in Miami, which would have been a great thing to have invested in the 90s. Let's all admit. And so now through technology, through like the securitization chain and the development of REITs, we have a public market security that allows 99% of the world's investors to have exposure to a diversified category of what used to be esoteric. So I'm just talking about the next phase of this stuff, right? So as you said, look, I am sure that, by the way, these sneakers, when I pass some of these shops, Dan, I'm like, man, I should have kept, I never had Jordans or anything as a kid, but even those like pump Reeboks that I had once, I should have kept the handle on those. Now I had my mom throw those away. Like how would anyone who say, okay, like I want to have access to things, but I don't want to, like a young person as they're like in their 20s now might go to one of those shops, pay $500 for a shoe, put it in their closet, hope resell it for $1,000. When they reach your age or my age, Dan, they're thinking like they don't have the time to make those small things, so they're thinking bigger. But maybe I want exposure to that. Maybe I want exposure to art. Maybe I want exposure. I mean, one thing that I think that I don't have any exposure to, maybe I want exposure to royalties. Like, I mean, everybody would love Taylor Swift's catalog, but there's a whole bunch of emerging artists who would love somebody to help them keep from starving in exchange for selling some part of their royalty stream if they make it. And they're just starting to blow up on TikTok. Like, we need technology. We need this technology to grow and develop to enable a vision that allows for that. And that is good for society and good for investors and good for the artists and the people who have cultural assets that they're willing to, I don't want to say sell, but share, allow investment in. And I think these things, like, again, like, we're just at the beginning of this whole thing. I mean, whether we're talking about NFTs or punks or whatever, I mean, these things are like the start of the start. Like, it's really, really.
You mentioned how early we are, and you know that I agree. I often have that discussion with my family when they say, "Yeah, what inning are we in?" I'm like, "Yeah, I think we're just coming out of batting practice." I'm sorry to say it. I'm looking around to let you know if the first inning's underway, and we'll get you some 99% with who are sophisticated, who are upwardly mobile, still have very little exposure, and probably limited understanding of where this puck is headed. Like, they generally know that NFTs.
Yours are nicer than mine for sure. So I mean, if there's an NFT for sale of Dan's watches, I'd rather have those than mine. But NFT, I think. So go ahead. Finish.
Collectibles.
Yeah, I mean, I'm gonna say something spicy, as you know, Dan, and
chimichurri.
Look, one thing that makes blockchain unique in technology is that it's tradable from the moment the token exists on a blockchain, because it's natively transactable. That's the point, right? The point is, the minute that NFT is minted, I can buy it from you and I can sell it to someone else. Very few technologies have that as part of their core architecture. You can't buy or sell the internet when it was being developed at DARPA. And I think, in respect of this like moment of early, like, what is going on in the NFT space, that set us back a bit because it created a mania. And a mania obscures, like, people, when I tell my family, like, oh, if they ask them what's an NFT, they think cartoon JPEG, they think Bored Ape or whatever, or something 10 times worse that maybe I would have owned some at some point. But the reality is, like, NFTs is a format, right? It's a format. So the speculative bit, which is unavoidable because the speculative enablement is native to blockchain architecture, has obscured, created this like big smokescreen, right? Like, and I think it's partly why we've gotten less development in that, like, those actual format-driven use cases that have been delivered because the smokescreen and then shrunk, and then people are like, oh, see, that was a nothing. It's like, no, that was like not the story. So we have to admit, the like speculative bit, it brings people to the table, you know, number go up. I mean, for Bitcoin for sure, that's been part of the evolution of BTC as a meme, as an idea, and now as like a pretty anchored piece of financial value that kind of, I think it's way past exit velocity that this thing represents real store of value. In the NFT space, that smokescreen hasn't really done that. Number goes up, makes more people interested, brings more use cases yet. But the tech is...
I like in the creatives, sure. Finders.
Wow.
These hotter than...
Well, I was walking with a friend of mine today. I mean, Dan, you're like reminding me. I was walking with a friend of mine today, this morning. Had a coffee and a walk in the sunshine. And it's London. So coffee, always, walk in the sunshine, almost never. And we're talking about like real estate in the UK and blah, blah, blah. This is a totally random conversation. And I said, listen, this is what I know about smart people in real estate. Follow the artists, follow the surfers, right? Like, and, you know, like, that's, you know, meatpacking districts, Soho, Tribeca, and then now, as you said, Bushwick, Dumbo, etc., right? Like, one way, London. Okay, when I first moved here like 20 years ago or whatever, right? Like, Shoreditch was not an area that you wanted to buy or live in, let alone Hoxton, let alone the further east you go. Now, boy, those prices are through the roof. The creatives bring the other creatives, which bring the techie and forward-thinking people who develop there, and then communities are built, right? And in the digital side, I think that you're right about that analogy, which is this experimentation. Okay, if 99% of the experimentation ends up looking like silly, it's still bringing people that are tomorrow's 100 examples, and only 95 will look silly, right? And then we have 5, 6, 7, then we have 10, then it starts, whoa, these people are really doing some really cool and interesting things, right? And I think that as we grow as an ecosystem and as a community, like, this will start to hit, and then like the hockey stick goes, right? Like, I think when you look at these hockey sticks of tech development, we always like look at these things, right? You forget that like what happens at first is this, you know, part of the hockey stick is flat. Like, we don't really know how long a flat you need, but I do know that once it passes like a critical point where these things are developed and people are comfortable, and we haven't solved for those necessities 100% yet. For example, like, I don't know, it's hopefully getting better, but how many times on X do you read about very experienced crypto people getting rug pulled, getting hacked, losing their losing their punk, losing their this, oh boy. I mean, if we were trying to grow the like Impressionism movement in the 19th century and on the like Parisian equivalent of X at the time, or Le Monde X or whatever it was, all you heard about is getting people's Monets snatched. You would be really, really reluctant to think about getting Monets into your portfolio. So, so I started in 2019. Well, I've always loved contemporary art. And I am by far from like a whale in contemporary art, Dan, but I lived in Japan for a long time. And so Japan contemporary was always my thing. I ended up meeting an artist. We ended up sponsoring his like exhibition in Australia named Tatsuo Miyajima, a super famous Japanese artist. And his canvas is LED number counters or LCD number counters, the things that go like 1, 2, 3, 4, 5, 6, 7, 8, 9, right? And he makes like these beautiful installations of number counters. And there was like an AI algorithm behind. I ended up buying a piece from him. He was super kind and generous. I still have to put it on my wall downstairs, and we have a new house. So I'm like reluctant. I need to, I don't know whether to like pay the outrageous art installers, but it's like super cool. I can just stare at it forever. So I love the idea of generative art. That was like my foray into generative art. Free NFT, free like all this AI explosion, right? And then in 2020, I started to see generative AI art, whether it was the stuff that was on art blocks or Refic stuff. I mean, you can see my book. I'm like doing this is like a real background. It's not like a blue screen or anything, but there's like an Age of Data, great book on generative AI art. Highly recommend it.
We see tennis balls.
With Wimbledon tennis balls and me and my kids, Simpsons, Arsenal. So my like little, everyone has their little shrine. So this is like a big thing for me because I think that like, AI art is art. The AI is just the paint. That's one thing I remember hosting Tatsuo and we had a chat in the office and whatever. And I said, like, what is it about the number counters? Like, what do they mean to you? He goes, what do you mean? What do they mean to me? They're paint. Right. Like, to me, like the algorithm's the paint. Right. Like, intelligence is the artist who is using this generative system to get unpredictable outputs. Like this is like innovation, which is we can have beauty without determinism, right? Like that's like a huge, Jackson Pollock, like throwing paint against like a canvas is beauty without determinism, right? Like, this is like revolutionary type of way of thinking art. So I started getting to collecting Refik Anadol's work, and I have a fair number of Refik pieces. I've been like fortunate enough to meet Refik in some of his exhibits. He did this great thing at the Serpentine here in London last year. Generative scents were there. I mean, like not just generative images, generative sounds. Guys, generative scents are senses being teased by an algorithm which says, this is what I think a forest smells like, right? Like this stuff is mind blowing. And I think, again, it takes a lot of time.
Lumen Prize winner.
Look, this is my view on art, which is every new movement in art is met with incredible skepticism. Right. And generative art is met with incredible skepticism. Let me tell you the two biggest gen art skeptics I know, my two kids, Oren and Bushi. Okay. Like my two teenage boys are they're AI generative skeptics in general. They love creativity. They're movie people. They love creating stuff. And they like, no, we need humans. We need humans. We need humans. Every great movement in art it starts with skepticism, impressionism, pop art, whatever you want to call it.
No
like the people are like, what are you
Andy
talking
Warhol
about?
Was laughed out of the room.
This is not art. When I hear this is not art, I go bing, right? Like, because that skepticism is what creates the healthy debate around what is aesthetics, what gives us joy, because art is really like what gives us joy from an aesthetic perspective. So I collect generative art. The blockchain format is a key part of that, right? Because it's algorithmic. So it's very hard. If I let's say have a generative art, let's say it's not NFT, there's no security, it's just like a file on my computer. I mean, I'm a Mac guy, but let's say it's a .exe for you Windows OGs. Well, then I just copy it and give it to Dan. And then Dan copies it and gives it to somebody else. And now we have 10 .exes from Refik, none of which have any like provenable, discernible provenance from each other. That's a problem. So now we have a solution, right? We have provenance-driven blockchain where there's transparency about, I can copy the file, but the copy is not the the original piece, right? I actually own the original work. Dan could
Provably
that it's not Dan's, right? The same way that like now we have like people with like magnifying glasses raking over Monets. By the way, I'm sure many fakes. So like maybe they don't rake over them as much as they should rake over them to try to prove and discern provenance. Well, surely there's a better technology than playing. And I'm like, okay, I'm being like super rude. Like a Swiss guy named Horst, and he's got like a handlebar mustache, and he's got like a bunch of different magnifying glasses and like sample cards, and he's like looking at your piece and looking at the signature and scratching his beard and scratching his head. Surely we can use technology for a better system. I know that this individual should have a good career or whatever, but we can do it a lot cheaper and better if we just have on-chain provenance. So technology like brings us to this world.
Borrowing.
Sure. Okay. So
against some of those digital assets.
Look, great point. So, at the moment, a lot of things that we own, not just, digital assets, are like hard. They're just not they're credit worthy. There's a big difference between something that's credit worthy and something you can borrow against. Like credit worthy means like a rational, reasonable person would lend you money at a reasonable rate of interest against it based on the attributes of that asset. Borrowable means, and then operationally I can do all of it and actually somebody is going to give me the money, right? And so I think that for me, part of the challenge is to make sure that operationally these things are all like legit, right? So for me, like what would I fear? Like putting one of my valuable artworks in a DeFi pool and not knowing that one day there's some like mark on OpenSea and I happen to be on an airplane and I miss my like, you need to top up liquidity or you're going to lose this really cool piece of work is a non-starter, right? Like, so lending against a liquid mark-to-market asset, like the kind of way we lend against crypto, does not work for things that are supposed to have more stable long-term value. It works when you're lending against a hyper-volatile crypto asset, caveat emptor. It doesn't work if I want to lend a Monet just because there's some auction in Belarus that printed a number that was low and now I lost my Monet. Sorry, that cannot work. So I want to see stable, and we want more long-term loans. Somebody has to say, okay, I want to lend you money. You don't have to look at the mark-to-market every day, but I'm going to lend you money for 6 months. That's okay. So that's good. Two, like the interest rate has to be reasonable. And this is like the dirty secret of the art lending world. Interest rates on paintings and major pieces of art are actually super low. Like if you want to borrow against a Monet, you would be shocked at how low an interest rate you pay against a Monet, right? Like you're not paying, 20% per annum. No, you're paying single digits, right? Because the Monet has provenance security. It's been in the market for a long time. People know that there's a universe of people that would buy that Monet if it was on 10% discount or 15% discount, even in a crisis scenario, right? We need that same thing to happen. So we need longer length of time to happen so that we have observability, value stability in the kind of like digital art space. And for a small number, which I know is Metaversal's like sweet spot of those things, the punks, like the really like the Sam Spratz, the works that are like really recognized as like leading, you get some of that. You understand like CryptoPunks have a base bid, right? Like, and it kind of moves around, but like the price of a punk's not going to drop 90% overnight. And so that's come to some part of the world, but we need that to more of the world. We need more collectors. So we need the art galleries to establish these kinds of floors too. I was really pleased to see this like giant Refik in the MoMA and to know that the MoMA is collecting these kinds of works. I mean, they bring culture forward. So I need to see all those things. And then, okay, safe and secure way, people I trust, right? Like whether the architecture is trustless or not, forget for a second. It's the gateway to that architecture that I talk about. Like who my art lender is going to be a person or a company. I'm going to look them in the face like Dan. I'm going to say, Dan, great. The fact that you use technology to manage this is great too, but like you're going to be my lender. I'm happy with that. Look.
And that's a very important point because when we think about trustless systems, when we think about peer-to-peer, and again, I go back to my older brother. And you don't invest.
Look, that is how by the way, every service provision has worked in every kind of context, blockchain or otherwise. But I mean, and I'll credit my good friend, I have a good friend named Omid. You can look him up. Omid's a professor at Columbia, Omid Malikan. He's written a couple of books on blockchain. The last one he calls Re-architecting Trust. I've taken his thought bubble and I'm going to re-express it this way. This is kind of like the way I express it, which is the total amount of trust required for me to get to the point where I am like borrowing against my art actually doesn't change based on technology. We just re-architect where it has to live. So if I have 8 gatekeepers, each one is regulated by like the SEC in the process, et cetera. Like the first person, I don't have to trust that much because there's like 8 gatekeepers, right? Like, so, but the total amount of trust is split between those 8. If we use blockchain to take out the 6 in the middle, saving a ton of cost because we use trustless architecture, it means the 2 on the edges have to have more trust. Because once I'm in through that first gatekeeper, I can't control through like suing anybody or whatever the like trust requirement in the middle. So the trust on the edges goes up. Crypto is like that. I say this about crypto all the time. Without Coinbase, Kraken, what a Binance, these like really trusted gate. By the way, that's why FTX was such a huge like disaster because it destroyed the trust in the gatekeeper, right? Like the blockchain, the Bitcoin was making blocks, right? Like all along, FTX goes down, Bitcoin's still making blocks, right? Like, so the trust in the gatekeepers has to go up. And the trust in the edges in what you're describing, Dan, is huge. And that's where Metaversal is like a huge winner because you have a brand, you've been doing it for a long. What creates that trust? How would I know to pick which company to go to orchestrate my art loan? Well, do they understand NFTs? Do they understand digital art? Do they understand pricing? Do they understand like what other loans have happened, right? Have they managed to like actually collect on a default? Like how do these things all work? And because Metaversal has been in that space for almost longer than anybody, right? That trust grows and grows and grows. And so for me, like that's why I'm so wildly bullish, Dan, on that opportunity, because actually it's the human trust, the trust in the organization, in the people, in the fact that there's a Dan Schmerin, not like a OX with, 19 characters that you've never heard of or whatever, who's there saying, there's this universe of trustlessness that's going to reduce costs and improve the outcomes. Here, it'll give you cheaper loans. It'll make things look more efficient, et cetera. But I'm your gatekeeper to that universe trust that we have been there for a long time. We know how to do all of this.
Question 1,
Whoa.
and then I have a second.
Whoa. Oh, wait, that is, 5 years is like an eternity. Okay, let me start with a couple. I'll do 3 views on the first one, right? That way, like if I go 1 for 3, I'm not Ted Williams territory, but I'm in like 30, batting 330 is okay. So I'll do 3 predictions. Right. Number 1, like Bitcoin will become a very well-established neutral reserve asset across lots of places in the way that gold is established. Central banks buy it, hold it. It's not going to be a payment, peer-to-peer payment system. I'm not going to pay you, Dan, in Bitcoin, right? But people will hold it as like an agreed stored of value asset, which is kind of like where this has gone so far, and I think we've reached enough escape velocity that we're getting there. And I think that's I'm giving you like a pretty easy prediction. So like kind of hopefully guaranteeing myself at least a seat on the podium batting 330. The second prediction is a little bit more spicy, which is there is not one chain to rule them all. We're going to be living in a universe of hyper-fragmented blockchains for the next 5 years. Right? It is unlikely, in my opinion, that all of a sudden we all just wake up one day and go, you know what, let's just use ETH. No. There are many great blockchain architectures out there. And again, like I think it's a ledger, it's a performant digital ledger and blockchain. There are going to be winners. There are going to be ones that are less winners, but there are going to be multiple winners. So we're going to live in a universe of fragmented blockchains. So one piece of art is going to be minted on Solana. There'll be another piece of art or whatever money that's on an Avalanche subnet or whatever, or something else on Stellar or this, that, or the other thing, or one of the many others. And we're going to live with that fragmentation because we're going to figure out, not through what I would call bridging and like adding operational risk, but there will be people who are intermediate across those ledgers for small fees, right? The universe we'll live in, it's like, think of the world of Circle kind of minting and burning USDC on different chains and taking a small fee. There's going to be a lot of that going on in a lot of different things, not just USDC. So, let's just strap in for the idea that we're in a not a multi-chain world, but a hyper multi-chain world, because
For
you have to have it
to help you navigate.
You have to have it. You have to have it, right? Like you're in the Tower of Babel. You need an interpreter. So that's maybe the second prediction I will make. But the third prediction I will make is that, and this is kind of like, okay, my 2030. So I like good thing. First one was kind of good thing. Second one was kind of like okay, we can deal with it. Like the third thing I'm going to say is the hardest thing. This is where I'm going to predict the real battle, the real regulatory battle, the real spicy point, the real point where philosophy, freedom, like, I don't know, I tend to be a libertarian type of person. It's that all these things intersect will be, and people have said this a few times in the past, and we keep forgetting it, will be unhosted wallets. That's the real story, folks, in the regulatory side of things. The real story is, will I be allowed to not use a regulated financial services company to move significant value? Right? Like, unhosted wallets have been sitting there. This question of like, okay, but what do we do about the fact that I could have a ledger or whatever, next version of a ledger or whatever, that has never been like connected to a regulated company. It isn't tied to my identity or whatever, and I can move value with it. That's what like keeps the regulators scared at night about enabling a large part of this ecosystem. The hosted wallets, the idea that you go to a Coinbase or a JP Morgan, right, or a Metaversal, and like your wallet's there and they're a gatekeeper and they provide you all this trust. I think in the end, 90+% of the world will be there. That trust is valuable. Regulators will embrace that. We'll have the like architecture between those people. But what happens to the individuals that are like truly want to stay out of the like regulated system and want that kind of freedom? And that's something that I think scares the hell out of the regulated community, right? Like if we, and we don't talk enough about that intersect, because it's kind of like this problem that's, whatever, like some people say it's a feature, some people say it's a huge bug. I'm like, I see both sides. I have lots of views that I won't share about that. But like, if I can move $20 million like this to someone anywhere in the world without ever touching anyone who's regulated in a completely anonymous way, boy, that's going to keep a lot of folks up at night that work for, security apparatuses, governments. That's a huge issue. And I think that in 5 years, that will be the predominant issue that we will be grappling with in the crypto community. Okay, that's my like spicy take.
Having started my career working on those very issues, I can second that because it just isn't going to fly. No regulator is going to accept that we go back to a universe.
Right.
Diminished.
So, okay, 60 seconds. First, Bitcoin is unique. It has no competitors in its value proposition. That's why it is where it is. Okay. ETH is not unique. It has competitors for its value proposition, right? With different ways of architecting technologically, community, whatever, to sort of like be that smart contract layer. ETH has chosen this kind of like L1, L2, L3 architecture, right? Like in the reality is ETH doesn't have like a foundation that's like sitting around in the same, it has a foundation, but in a different kind of way than some of the others that try to generate that kind of community. And then there's this whole theory that like most of this stuff will happen way up here, and the like a base layer will only have those like big trades or whatever. So where's the value accrual going to be? So to me, like that's part of why the like gloss a little bit's fallen off of ETH, and some of its ETH competitors have grown in L1 space because it's easier to sort of like measure out. There's only one chain or whatever. There's only one base layer. That's where all the activity is going to be. We're just going to build this hyper performant L1, etc. My suspicion, right? So this is my view. Right? It might be totally wrong. ETH isn't money. Right? Like a Bitcoin is some kind of money. It's some kind of like, I think there's a book written that I really enjoyed that a friend of mine put me onto called Resistance Money. Look it up. I think it's a really good way of describing what Bitcoin is. It's resistance money. I don't believe ETH is money, right? Like ETH is more like petrol or oil or whatever, and it has competitors, natural gas, oil, natural gas, coal, blah, blah. It has competitors, right? Like, and so I think ETH is just like struggling with its competition, right? In the end, like there's a certain bucket, more and more competitors coming in. That's how the pie is growing, but then ETH share may be shrinking as part of that growing pie. I have my only way of thinking about this is like, what return do I get from holding ETH? I get staking yield. Like I'm not getting emissions. Let's just say inflation is 0. It's within like a epsilon of 0, one side or another. Certainly not. So like, if you're telling me that like I'm getting 8% staking yields from ETH, I'm like, whoa, that's cheap. I'm getting 8% plus like this thing could grow and I could get more network activity. If you're telling me I'm getting like 0.5%, almost nothing staking ETH, I'm like, boy, ETH seems very, very expensive. I think it's stuck somewhere in the middle. So my view is ETH is here to stay. It will be a dominant L1. There will be an L1, L2, L3 architecture on ETH, but it will have
playing card. Was it?
Dan, what an awesome question, because I can tell you for me, it was the 1986 Topps full set NFL football cards. which I think
Bam.
which I think had, if I'm not wrong, the Jerry Rice rookie card in it and a couple of others. I was a football card. So 1986, I was 8. My brother was 11. Okay, so like I had like half a scratch of maybe $10. So I think I paid $19 for the full set. I still have it at my parents' house. It's all in all those sleeves, card, the sporting card collectors, football card, baseball card collectors. You know what I'm talking about, right? Like each in a sleeve, right? I took it out of the cardboard box. It's all still there, probably in my bedroom, which my parents like probably don't touch. It still looks like my bedroom from when I was effing 10. Mom and dad, you can get rid of my room and turn it into like something nicer. Okay, no problem. But I remember two things. One is the idea of owning that, like. And these are collectibles. Collectibles is, I think, for young people, the first thing that they really get excited about owning. My kids collect these things called, Blu-ray. Well, they collect a certain kind of Blu-ray. They collect something called the Criterion Collection, which is like the Louis Vuitton of DVDs or Blu-rays. Okay, collectibles, I think, always brings young people into the idea of ownership. Right. So I had those football cards, but then I want to like make another. Well, maybe even more excited, and this I look back there was this magazine that used to come out once a month, and it would give you a price or a value on all those cards. Like I forget the name of the magazines. Somebody will remind Beckett. You get this magazine. You remember, Dan? You remember, and you like go through. Of course, like there was like generic. Like football players that like never did anything, and then you get to the like Jerry Rice rookie card or whatever, and it would have like a real value, and we watch it change month to month. And this, I think, is where the speculation, the heart, it all comes together. Which is, I never once sold one of my football cards to one of these football card shops, but if a friend of mine got that Beckett, I would be like all over it because we like to enjoy seeing the values go up and down. There's parts that brings people to the table. So for me, like it was football cards. I think at some point those things crashed like 90%, very crypto-like. At some point they came back a lot, just a very crypto. They came back a lot. I don't know what that set's worth. I think when we're done with this podcast, I'm going to like Google 1986 top full set NFL cards. That's the first thing I remember to own. Cost me $19.
Yes, and you're right. Hundreds, thousands of them, and they didn't figure out the scarcity element that we have incorporated into many.
But that Honus Wagner 19 whatever is still worth $1 squillion, Dan. So there's still a value to the original, these things that really like create the cultural zeitgeist. I mean, this is where I think metaversal you play in the NFTs, these things that are special, right? That they created the cultural zeitgeist, that early 1900s baseball cards to enable a young punter like me spending $19 of my harder work. I don't know. Maybe I helped my brother mow lawns or something. I don't know how I got that $19, by the way. I didn't take it from your wallet, Dad. To have enough money to buy that set. But these are like the cultural propagation, and then like lessons are learned because look at the shoe industry. They don't mass produce these special seekers. They've figured out that like scarcity is important.
Thank you for taking time ahead of tonight's big matchup. And it's always
yeah, thanks so much. Come on, you Gunners, tonight. And by the time anybody sees this, the match will be long over. But Dan, as always, thanks for your friendship. And like, I wish, of course, all of my friends in Metaversal, like, up and to the right.